Hey everyone, welcome to our webcast. Pleased to see you all here. I think we're going to get started with housekeeping and introductions while people are starting to join here. So we'll just give another few seconds and then we'll get started. Okay, so our webinar today is how PE-backed CFOs can gain efficiencies when adopting new accounting standards. I'm Shauna Watson. I'm a managing director with Accordion. I lead our public company readiness practice. And I have some wonderful panelists with me today that I'm going to introduce in a minute. First, let's go through some of the housekeeping. This is a CPE eligible webcast if you registered and meet the requirements. So we are going to be having a Q&A function, and Alex Bogopolsky, one of our senior directors that I'll introduce in a minute, and leading our Center of Excellence will be responding to those questions. If there are some that are more relevant for the whole group, we'll bring those up for the whole group if there's time as well. There will be some interactive polls. We'll have 4 polling questions. You need to answer 3 of them in this 50-minute session in order to get your CPE credit. And then at the end, if you're on for 50 minutes and answer the 3 polling questions, we'll send you a CPE certificate in 1 to 2 weeks. With that, let's go ahead and introduce our panelists. So first we have Mark Garrett, and Mark Garrett has a long history of consulting with PwC and RGP, amongst others. He's also been internal in technical accounting at American Express, as well as some other roles. Cheryl Shellhammer is also a senior director with Accordion, has a history of consulting with PwC and RGP, as well as Becker's CPA course. And we also have Alex Bogopolsky, who is leading our Lease Accounting Center of Excellence in Technical Accounting. He has a history of KPMG and PwC amongst controller roles. And quick introduction about Accordion for those of you who may not know us, but Accordion's a boutique consulting firm for PE-backed companies. We focus on the office of the CFO and provide services, everything from operational and technical accounting, such as we're going to talk about today with the new accounting standards, a lot of audit readiness projects, digital and finance transformation, technology optimization and implementation, strategic FP&A, KPIs, reporting packages, budgeting and forecasting, and 13-week cash flow, and transaction execution services, buy-side, sell-side readiness, as well as IPO and SPAC mergers. So we are very pleased to host you all today on this webcast, and I'd like to introduce Isaac Heller from Trullion to tell us a little bit about his company and himself.
Hey, Shauna. It's good to be with you again. I think we were at a panel similar maybe 5 years ago in Chicago. So a lot has happened since then. I'm now in the Accordion office in New York, coincidentally, with some of your colleagues. But look, my name's Isaac. I'm CEO and co-founder of Trullion. We're an AI-powered financial technology company. We also work with the office of the CFO. And in areas like lease accounting, we partner with firms like Accordion to make sure that the clients have an end-to-end solution. We're focused on the software and really providing innovation in the office of the CFO.
Awesome. Well, thank you for joining today. So today we're going to talk about adopting new accounting standards, primarily ASC 842 and ASC 606. 842, of course, being the lease accounting standard for US GAAP, and 606 being revenue recognition, as well as some that have been around for a while, like software capitalization and regulations such as ESG. I imagine this time will go fairly quickly. There's a lot of information that I know our panelists are eager to share here. But our goal through this webcast is really to relay some of the best practices that you can use in adopting these new accounting standards to really drive efficiencies, and therefore efficiencies equaling value from what's largely viewed as a compliance exercise. And in order to get started, let's go ahead and start with our first polling question, if you wouldn't mind, Claudia. So the first polling question, what is your lease accounting implementation status? And here you can select one choice. You're done, you're in progress, almost done, not started, but planned in the next few months, or not applicable. And while we do that, maybe we can start with a little bit of an overview of the market trends and some of the things that we're seeing out there that to really frame the discussion here. So one of them, of course, these are not going to be any surprise to anybody, but the M&A markets and the private equity investment, lots of AUM out there, that activity continues, even as we've seen a decline in some of the IPOs and SPAC mergers. We are still hearing from quite a few SPACs that want to do de-SPAC transactions, and therefore they need public company readiness. So this is very applicable to them as well. Companies are still looking for an eventual exit, and everybody knows that the markets will not stay down forever. So trying to get ready for that in the future. We've got rising interest rates and inflation, trying to get the economic matters under control. Supply chain introduces a lot of uncertainty into the markets. We've also got record-breaking take private deals by some of these PE firms from the public markets, which stands to reason given the downturn in the public markets. Then, of course, we've got all these new standards to be adopted. The FASB was really active for quite a few years, the revenue recognition leases, CECL, as well as the upcoming ESG requirements. Then, of course, we've got staffing issues. I'm sure everybody's feeling the squeeze on that, the great resignation, as it was talked about, now the new quietly quitting phenomenon, just in general, a shortage of qualified people in finance and accounting positions. You know, one of the things that I've observed being heavily involved in IPOs and SPACs is that all of these new public companies need qualified people in financial reporting and technical accounting, and they're drawing them away from the audit firms, which seems to be delaying the audits a little bit more. So certainly that is a challenge in hiring. And then, of course, lots of progress on technology and automation. I want to talk about that in a minute, but let's look through the polling question here. We should be able to see the answer on the screen now. It looks like a few people are done. Congratulations. A few more in progress or almost done, and several not started or not applicable. So should be a good group. Hopefully, we can give some good suggestions. So Isaac, when we're talking about technology and automation trends, a little bit more broadly than potentially lease accounting and revenue recognition, what are you seeing in terms of trends?
Yeah, definitely. So speaking as a founder in the software space, right? So we would be in the growth equity area where investors are constantly reaching out and thinking about evaluating or investing in firms like that. The market has noticed that CFOs are very, very focused on software and services that help them gain efficiency. So whereas the past, 10 years have been more of a bull market, a lot more focused on growth, everything's good. Now people are turning around and looking at those projects that help impact the bottom of line. So it trickles to our industry as a software. You talked about take privates, companies like Anaplan, Avalara, companies that help drive financial efficiency, are all seeing a lot more interest from CFOs. So it's been a really exciting time for us. A lot of focus on, AI-powered software that drives efficiency.
Yeah, I think that's a good point. I mean, certainly amongst our clients, we've seen technology really becoming table stakes at this point. Digitization and automation, maybe in the old world, investment in software and technology wasn't a priority for PE-backed companies because the ROI took, maybe 3 to 5 years, and that was kind of the same as the exit plan. But at this point, if you don't have that efficiency driven through your back office, it's not going to drive the value and the exit that you want. Mark, let's turn it over to you. Can you tell us a little bit about why these market trends, such as the unprecedented deal activity, the uncertainty in the markets, the people issues, technology, why are those important to PE-backed companies as they look to adopt these new accounting standards?
Well, I'd say the short answer is that it's important to be able to produce and have GAAP financial statements. So something we see very common and very regular when we go into companies, they don't have GAAP financials, or sometimes they have financial statements that are partially compliant. Maybe their accruals are in order, maybe they haven't adopted 606, or maybe the revenue is still on a cash basis, or other specific standards, like you mentioned software cap earlier. Sometimes they haven't necessarily adopted some of the more complicated ones. There could be a number of reasons behind this. It was largely viewed as a compliance exercise. There's frequently no real benefit perceived. Sometimes it was too cumbersome. Frequently, they just simply lacked the technical expertise. So whatever the reason was, it's been very common that companies do not have full GAAP financial statements. So you mentioned some of the recent deal activity that has led to an increase of companies needing to adopt. So specifically, there are companies that, even though 606 has been out there for quite some time, they're just now going through the process, or some have yet to go through the process of adopting 606. The implications of not having fully GAAP financial statements or having not adopted the standard 606, 842, or any of the others, they can be significant. For example, they can impact your time frame for getting your first audit completed. They can lead to delays if you're looking to raise capital, for example, new investors or debt. They can delay that entire process. Experience I have right now is a company or a client currently working to produce their GAAP financial statements, and they really cannot get lenders on board until they have those. So how long of a delay? That can vary, considerably. Sometimes it could be, a matter of, perhaps a few weeks. It also could drag out to be, possibly a number of months. The question really depends on the complexity of the standard. 606 and 842 can be very complex. Depends on the number of transactions, quality of data, and also ensuring that you have an efficient process for adoption. So the kind of a less efficient process clearly is going to extend the time frame. Something that's worth noting as well, though, is that it goes beyond just accounting. So having GAAP and fully GAAP compliant financial statements has implications beyond just having the accounting correct. For example, and I mentioned a moment ago, a client that had a software that they were not capitalizing. In that instance there, they're expensing all their software costs that were eligible for capitalization rather than putting them on the balance sheet and then amortizing them. So there are true implications beyond just accounting. As you mentioned earlier, though, it's likely on the horizon that we're going to see a slowdown in certain deal activity. I just want to emphasize the point that doesn't mean and shouldn't be taken as a signal that you don't need to go ahead and get your financial statements compliant with GAAP. For example, if you're trying to raise capital, as you mentioned, or perhaps you're looking for an exit, often fully compliant GAAP financial statements would be important.
Yeah, great point. We see that a lot when all of a sudden some transaction comes up. And the thing that always seems to take the longest is the audit. And of course, you can't do an audit until the financials are ready for an audit and everything's properly reported. So good points. Let's start with talking about lease accounting, since that's kind of the one that private companies are most focused on right now, assuming that they have already adopted ASC 606, which we'll talk a little bit more in a bit. But Cheryl, can you give us a high-level overview of the requirements of ASC 842 and the timing for private companies for those who may not be familiar?
Yeah, sure. I mean, this wasn't something that was just recently talked about. I mean, the FASB issued the standard in 2016. The whole goal was to close the loophole of off-balance sheet operating leases. The standard was delayed twice, the first time due to companies just not being ready, and the second time due to COVID and the resource constraints that companies experienced as a result. And then the question of delaying the effective date for private companies was back on the table in late 2021, but ultimately the FASB voted unanimously against that. And so no deferral. ASC 842 remains effective for private companies who have not already implemented for fiscal years beginning after December 15th, 2021. That is calendar year companies. The effective date is January 1st of this year. And then interim reporting commences in 2023. The definition of a lease changed under 842. This concept of control was added, similar to the control definition in 606. So an arrangement that's a lease or contains a lease has to convey the right to control the use of an identified asset, as well as obtaining substantially all the economic benefits. That was one big change. For a lessee, lease classification is either a finance lease or an operating lease. Lesser accounting remains consistent to 840. It follows a similar classification criteria for leases, sales type lease or direct financing lease versus an operating lease. The bright lines for determining a lease classification were removed. although the standard does call out that a reasonable approach is still to use those bright line thresholds that were under 840. So determining whether the lease is for a major portion of the asset's remaining economic life or whether the lease payments represent substantially all of the asset's fair value is still 75% and 90% thresholds that were applicable under 840. And as best practice, we're seeing clients still use those thresholds even under 842. Another change, I guess, if you will, under 840, initial direct costs are those capitalizable upfront costs. We saw more of those under 840. We're seeing more expense under 842. There were practical expedients that were allowed for the transition, as well as ongoing practical expedients. For example, lease terms with less than 12 months are not required to be capitalized. Private companies have the option of using a risk-free rate to apply to their incremental borrowing rate or their IBR. I think the biggest impact, though, as we think about financial statements is that, one, you may identify leases you didn't even know you had, right? So that's a notable difference that I think companies are seeing. There's the intent of the standards to close the loophole on not capitalizing leases has virtually gone away, because now we're grossing up the balance sheet. We're recognizing a right of use asset and a lease liability for virtually all of our leases. Our balance sheet treatment is now we're bringing a right of use asset on the balance sheet, which is a long-term asset. Now we may have implications under impairment, considering another long-lived asset. Operating and finance leases are presented and disclosed separately on the balance sheet. That creates a little bit of complexity. On our income statement, our operating leases are expensed straight line over the lease term. That's not totally different, but a finance lease, our amortization and interest expense are now added back in determining EBITDA. And of course, our disclosures are much more robust, with the whole intent of creating better transparency and visibility into a company's overall commitments, which of course is what the users of financial statements have been asking for.
Yeah, thanks for that summary. That's a very good summary and a lot of information in a short period of time. So nicely done. Regarding the change in the bright lines, I mean, I think mostly what we've seen through the public and the private company adoptions, and Isaac, you can tell me if you've seen something different, but that they are sticking with the 75% and 90%. I did have some clients that, because of what you mentioned, Cheryl, with the EBITDA, if you have finance leases, although it characterizes the liability maybe less favorably from an EBITDA standpoint, it makes the EBITDA better because now you have interest and amortization expense as opposed to operating lease expense. But I found mostly that auditors have been sticking by the 75 and 90% rule unless there's some major reason not to. Isaac, have you seen something different?
No, that's very similar on our end. Obviously, there's a lot of other challenges we've seen, which I'm sure we'll get into, but that's been pretty consistent in the private markets.
Yeah, great. Okay, before we get into some of those challenges, let's do another poll, Claudia, if you wouldn't mind. Okay, this poll says, do you plan to use lease accounting software? Yes, already implemented. Yes, selected but not implemented. Yes, not yet selected. No, and not applicable. So while we're talking about lease accounting software and giving you all a minute to answer that question, Isaac, maybe you can tell us, I've heard so many different views about this, but how many leases do you actually need to make a software tool worthwhile?
So as a software vendor that's seen before, during, and after, 10's the magic number for us. And then we've heard people go as high as 50, right? 50 being the threshold. I would say there's compounding factors, right? If you have 10 copier leases or 50 copier leases, might not be worth the investment for software. If you have 10 that are in 10 different currencies, that might be. If you have a couple entities and you're heading into an M&A transaction, software is going to be really powerful in helping consolidate all those financials. So there's a magic number, but then there's also compounding factors, like I mentioned, FX, M&A activity that can really provide a lot of value with software.
Yeah, I would agree with that. Mark, have you been seeing anything different with yours? I know you've had quite a few clients that have just chosen to use Excel in the past. What do you think the magic number is?
I would say 10 would be a good rule. And if it's less than companies probably think that it is, you could probably build something in Excel that you can kind of, work your way through it. But the fact of the matter is it's very quickly going to become very cumbersome and it's going to be prone to errors. And if you have any complexities in your lease portfolio, it's just going to create challenges. So I really encourage companies with any number of leases at all to seriously look into software options.
Yeah, great. Okay, looks like we have the polling results back. So it looks like some people have implemented it, some have selected and are working on the implementation, and some are not planning to use it or have not yet selected it yet. So let's move on to some of those challenges you were talking about, Isaac. What are the biggest challenges you've seen with companies when adopting lease accounting for the first time? Isaac, do you want to start?
Yeah, definitely. Well, from our perspective, we're a software company that's indexing all sorts of industries, public and private equity-backed companies. And we've got a support team at Trullion. And so we're able to see a clear line, on what things get requested or questions that get asked the most. The first thing we see is that companies that implement themselves versus working with a partner like Accordion, they end up having a lot more challenges on day one, right? So we automatically see the importance of investing in readiness. Those questions mainly are around things like identifying leases, what's actually a lease, and then within a lease, what are the actual material terms that I should be aware of? Number two is IBR, right? That is the question we get all the time. Again, it's compounded if you're in different countries, complex terms, multiple asset classes. Those are a couple of big ones. And I go back to, again, the compounding effects of needing additional education or software, which are things like FX, M&A, dual reporting can get really complicated if you have one subsidiary that needs to have some local reporting. These are all areas where we see additional support and questions around those.
Excellent. Mark, do you want to take a stab at that too?
Yeah, I'll just, the one that you hit on that comes up a lot, I would say, is IBR. So coming up with incremental borrowing rate. And often companies, if you're a private company, of course, it's not necessary.
Uh-oh, Mark, you're cutting out a little bit. Mark, you're cutting out.
IBR. So just having oh, sorry, I guess just having not a
Cheryl, do you want to offer some thoughts on that?
Yeah,
okay, I mean, I love technology. Can you guys hear me?
I love technology.
Mark, you cut out for a minute. I'm going to give you a break for a second and have Cheryl address a few of the things you probably just said.
Well, one thing I think is interesting is kind of creating this audit trail, right? And I think we forget about that when we're going through the implementation, right? We're so focused on the accounting, we forget on the back end audit. And that does create challenges, especially with staff turnover, which kind of gets into some day two issues as well. But I think we also forget about modifications and what that impact is for companies. The modification guidance is a little bit different under 840 than it is under 842. And so, not understanding some of that technical accounting could lead to some issues as we're implementing. I think that's created, especially, and Mark alluded to a lot of his clients, using Excel. Maybe it's relatively easy applying Excel for your transition or your initial accounting. But then as you have modifications going forward, that can create quite a bit of challenges. So those are just a couple of things that I've personally experienced with some of my clients in implementing 842.
What about, Mark, maybe you can take, I know you were talking about incremental borrowing rate, but what about GAAP versus IFRS and even logistical issues such as tracking down leases? Have you seen issues in that?
Absolutely. So tracking down leases can be one of the bigger challenges, both logistically and then also, like we talked earlier, about identifying the population of leases. So the population is not necessarily just those that have lease on the letterhead. It's looking for embedded leases and trying to identify the entire population. But then again, gathering them, they're often scattered often throughout the world. They're often in different languages. So there's some logistical issues there. You touched upon it, Isaac, earlier, but if you have companies that have multiple, different reporting, IFRS, for example, there are a lot of similarities, but they took fundamental different routes in their final conclusions on leasing. So it often creates challenges to be able to produce US GAAP and then IFRS financials. So those are just a few. There's a host of other challenges that are out there, which is again why it's important to have an effective and efficient process for adoption.
Isaac, one more question for you on this. What about roles and ownership? I've seen a lot of different scenarios within mostly large public companies previously, but who is it that you're seeing owns the lease process in most cases?
Yeah, well, it's the corporate controller, especially with private equity-backed companies. I think in larger enterprises, and going back to the public companies, there was a lot more involvement from facilities and even procurement in certain cases. And by the way, that should still be the case if there's a facilities team and a procurement organization. It's very important to have cross-functional alignment. But a lot of times, our private equity-backed companies are running a little bit leaner, right? And so you might have a controller or even a CFO that actually has a lot of oversight of some of the facilities and procurement questions. So it's a lot of times contained on a slightly smaller team.
Yeah, and I can't forget about legal, who needs to keep track of some of those leases we were just talking about as well. But everybody, of course, has different goals with what they're interested in, whether it's getting the best rates and making sure that the space fits the needs, which we should talk about as well, given COVID and how companies are downgrading space as leases come up and such. But anyway, there's definitely a lot to think about there. What about challenges that you've seen after your initial adoption, day 2, as we call it? Isaac, do you want to start on that?
Yeah, definitely. Well, going back to kind of the analysis we have, when do we get the most calls? Well, when there's a transaction or an audit coming, right? So, your sponsor is requesting a lot of financial data, making sure that you're really, really confident in the audit trail and the actual journal entries and disclosures that you produce, especially if there was, as an example, like a modification that may not have been, you may have downsized or renewed, but you didn't actually account for it at that time. So you have to kind of go back and retroactively make sure everything's okay. From an audit perspective, we get a lot of calls when people are getting ready for disclosure season, making sure that you have, a fully compliant ASC 842 disclosure. And so those are kind of the 2 trigger events where people start asking a lot of questions.
Cheryl, do you have any thoughts on that as well?
Yeah, I mean, similar, certainly. We talked about modifications, of course. I think the other thing is staff turnover. You spend a lot of time, money, and effort going through your 842 adoption, and now that team is gone. There wasn't great documentation, didn't keep good records, didn't implement a software. And so now I've got a whole new team, and I kind of need to go through this again because, we didn't really pay attention too closely. So that, unfortunately, has been an impact subsequently. And just general processes, regardless or not if you're subject to SOX, I think just putting a good process around your lease and outside of accounting, starting with facilities, educating the facilities and, in the field, engineers or whatever the scenario is, understanding how to find a lease. Before, there wasn't a big accounting implication if you didn't capitalize a lease. An operating lease was still pretty much treated the same. But now looking for these embedded leases, whether it's operating, you're still capitalizing and training your in the field people to understand what that really is and what that means could have a huge impact depending on the type of leases that you have. So I think those kind of day 2 gets forgotten and process is a big part of that.
Yeah, training's always an issue, how much training to do. And with the turnover, certainly a software solution can help with that audit trail and the record so that it's easier for people to step in. And the thing with leasing is that so much of it has been decentralized over the years. There's on the one hand, now you have to keep control over what leases are happening. On the other hand, you don't want to cripple the business by having too much control and not letting your people out in the field be able to enter into operating leases. Yeah, great points. So let's move on to maybe some of the lessons that were learned from public company adoptions. Certainly, you know, those companies have now been through, of course, the initial adoption, several rounds of SEC comments, and certainly a lot of lessons learned that I think that we've all been privy to. Mark, what have you seen from some of the public company adoptions that apply to private companies?
I guess a few challenges that have kind of popped up is one is it tends to take longer than people have thought. So I think sometimes they underestimate what's going to be involved and what the duration would be. So the recommendation would be to start early. So make sure you begin the process and give yourself a lot of time on the end. It would be better to be able to put your feet up at the end rather than running into a crunch. Something we touched on earlier is, again, I think getting some thought as to what your longer term plans are. And so specifically, I'm thinking about the incremental borrowing rate. It's very easy. You can find a risk-free rate by just simply going on Google and looking for one. But to find your incremental borrowing rate clearly is not going to be that easy. But it may pay dividends down the line if that is what your intent is to either go public or become part of a public company. So just a few notes there.
Yeah, that's great. Isaac, if you are moving from a private to a public company and you initially implemented a risk-free rate and need to change to IBR, I imagine that's easier if you had a software tool.
Yeah, it's definitely easier. Again, you still have to, work with third parties in your team to make sure that you're identifying the correct incremental borrowing rate. But, software is really great for, again, these transitionary moments, whether it's M&A or public transactions. And you can, do what's called bulk or automated, updating of these borrowing rates. It's significantly easier to do it in software than Excel.
What else, when you talk to public companies, do they wish they would have known when they were doing it the first time?
Yeah, definitely. I think start early to Marcus's point. And everyone thinks like that. And, when the rubber hits the road, it's hard to get that mobilized, especially when you're resource constrained. But I think what you see in the market, again, the standard was delayed. Like, we have to remember that the standard was actually delayed a year after being pronounced, as Cheryl said, in 2016. So clearly there was some, mistake in anticipating what was needed to be done. I think one of the things nobody expected was the capacity crunch, right? Because you have everyone trying to comply to a certain deadline that's been procrastinating. And whether it's, service providers or audit firms or software companies, everyone's being called at the same time. We're seeing our demand significantly go up as we get closer to the standard. And I think that's what happened in the public companies. So they picked up the phone, before audit season, and Accordion didn't have, the full resources to help, or had, what I mean? Or the software companies had to wait a couple of weeks to get stood up. And so those were a lot of the issues that came up.
Yeah, I think the capacity crunch is going to be something that we will likely see for the year-end audits here in 2022. So I guess if I had some piece of advice, it would, not to sound trite, but starting early, if you have auditors that are coming in for interim procedures and you can get them to audit the transition adjustment, that's going to be very helpful because the transition is as of 1/1/22, even though you don't have to reflect it until your annual financial statements. So, it doesn't seem like the auditors are able to speed through as quickly as they have in the past. I think that's somewhat due to staffing shortages, but I'm anticipating this year-end audit season being even a bit more difficult because everybody's going to have to also audit the ASC 842 implementation. Okay, so it's great that there were challenges and we've learned from those from public companies, but are there some strategies or opportunities that you can employ, not only looking at compliance, but potentially in creating value and ROI? Cheryl, do you want to start with that?
Yeah, sure. I mean, I talked a little bit about process earlier. I think one of those is just lease versus buy analysis, right? So companies either didn't have great processes or didn't really put a lot of emphasis on that in the past. We're seeing, instant ARR ROI just from that process. I think the other thing too, especially with this concept of embedded leases. I mean, that still existed under 840, but again, companies didn't spend a lot of time going through that analysis. And now finding out that they've been paying for an embedded asset, essentially it's a service contract. They're thinking it's a month-to-month payment, but now realizing they're actually paying for an underlying asset and they've paid for it 2 or 3 times over through the course of that lease term. Really kind of going through that and analyzing, you know, hey, we need to be restructuring this contract to get a better bang for our buck. I think that's been definitely some ROI right out of the gate. And then, you know, just as Shauna mentioned earlier, you know, our EBITDA gain, right? So properly capitalizing a finance lease to get some of that benefit has definitely helped. Isaac, anything different in addition that you've seen or?
Yeah, definitely. Well, also, what I've seen, but also what we haven't seen. You know, there's kind of a holy grail here, right? Especially after COVID, which is, hey, if I could centralize maybe my 3rd largest cost center as a CFO, I'd really like to know how that's being utilized. So the holy grail would be able to centralize that lease data, understand, and then also centralize some level of utilization data. How many people are utilizing the space that I'm spending a lot of money to lease? How many people are utilizing the vehicles that I'm leasing? So being able to bridge those, I think would be really, really good. I think most CFOs want to do it. There's some barriers there, especially with time and resources. But to your point, Cheryl, the first step is centralizing that data, you know, in a clean process. And then hopefully you can come back, you know, whether it's in 6 months or a year, and actually start to find a little bit more ROI there.
Yeah, companies, especially PE-backed companies, always focused on cost takeout and having an actual transparent view of what you're leasing, why you're leasing it, and do you really need to spend that money? I mean, if the primary goal was to keep assets off the balance sheet, that's not a great reason anymore because they're all on the balance sheet. So excellent points. Okay. I mean, it's great that there's ways to create value in this. Most of the time we just see compliance exercises being exactly that. But now we've identified some ways that you actually can create value. But the focus of this webcast, of course, is gaining efficiencies. And efficiencies are typically gained through technology and process. So Isaac, do you want to tell us a little bit more about the technology?
Yeah, definitely. Would you like to see it, Shauna?
Yeah, let's see it.
Okay, so let's give it a look. So again, this is the Trullion technology, and we'll also talk about it in the context of how you could think about your process. Can everyone see my screen okay, Shauna?
Yeah, that's right, we can see it.
Okay, great. So what you're looking at is an ASC 842 workflow on a single lease. Your leases could be in an Excel format that you could upload or an existing system. This is an example of a PDF agreement that could be loaded into a software like Trullion. AI has come a long way in the past few years. It's not a magic wand, but what it can do is it can help with decision support. For example, identifying start dates and end dates and financial payments. In Trullion, you can click on an arrow that identifies a term or a payment, and it allows you to review that payment. Now, what that does is it gives you a bookmark, whether you're going to have to be revisiting that in a year or two, whether you're going through an audit, or even whether you're working with your partners like Accordion, you could at least help document a lot of the effort that's been made to get compliant. Now, ultimately, those inputs from the lease are moved into payment streams to make sure you're parallel with your ERP system. What we would call judgments, which is where you're working internally and with Accordion to understand what types of IBRs you're implementing and all of the other questions around initial 842 balances, and then moving into a schedule. So this is a really good visual of some of the impacts of 842. Cash flow is obviously very similar, but the big thing is a new right of use asset on the balance sheet and then a depreciation asset and liability. Obviously, you've got some changes around P&L and interest as it relates to 840, from 840 to 842. And then once you're in software, you could do a lot of what we would call other calculations, which may include things like helping with exchange rate gain loss and other strategic areas that could help drive ROI and leases. So from left to right, we've gone from reviewing the document to helping with the schedules, different currencies, different standards, and then ultimately reporting. Reporting could be for compliance, which is sending this or integrating with your ERP, creating a disclosure report, or even going back to our IRR conversation, seeing a waterfall of your, upcoming lease payments and expiring leases, and having critical alerts and reminders to make sure you're proactively managing that. So that's a bit about Trullion. I hope that was Sean, was that a good visual to give you an idea?
Yeah, I really like the audit trail that the AI tool creates. That's very useful. And, obviously it's not a magic bullet, as you mentioned, but I think it helps when you're getting through either lengthy leases. Mostly what I've seen is very useful when the leases are very standardized. Obviously, the tool learns quicker at that point and can draw out the relevant terms. One thing to think about is, sometimes I talk to clients and they say, oh, we only have 3 leases. But if they're master lease agreements, then they may have hundreds of assets, particularly vehicles or forklifts or whatever underneath that. This is an asset level standard, and those need to be entered separately unless they're all placed in service at the same date and out of service at the same date. So unless you can get some sort of a portfolio approach, they really need to be tracked separately. And having a tool like AI that you can get through them quickly, I think has tremendous benefit. Okay, so let's move on to the process part of that. Cheryl, do you want to talk a little bit about, we've implemented lease accounting for a lot of companies. We use sort of what we call a lease in the box standard. Talk about what a typical implementation is like.
Well, typical is somewhat standardizing it, right? Because of course, as you know, the company to company, industry to industry, has a wide variety of a lease portfolio. And that does matter in the implementation phase. As Shauna mentioned, one lease with 100 leases underneath it would be much different than maybe, 10 standardized office leases, for example. But in general, going through the process of adopting the standard, it is the same regardless, right? You first have to identify all the leases that you have. And as I mentioned earlier, you may discover there's a lot more with this, with embedded leases in your service contract. So first, identifying the leases. Then you have to not review the contracts and extract the data. Again, depending on the volumes of pages of leases, whether it's in a paper format or a PDF format, having an AI tool to help you extract that data can be extremely efficient. And then, of course, determining the accounting of the leases. What is the lease account classification? What is my, initial adjustment? And by the way, what are my adjustments on a go forward basis? Am I going to have future modifications? Kind of, getting that in a box, if you will, understanding what your portfolio is and what impact it's going to be on your financial statements going forward. And then, of course, if implementing a lease software, whether that is using Excel or something more automated than that, is a consideration in the process. And then, like I said, finally, your day 2 and go forward accounting. So at a high level, every company needs to do that. And then how difficult that is or how much time you need depends on your underlying lease portfolio.
Yeah, great. Hey, Isaac, your demo, I think, drew a question from the audience. And since we're already kind of talking about that, I'll just run through it real quick. But it says, how does Trullion handle dual reporting for US GAAP and IFRS? Can you input separate judgments for each standard? Are the beginning balances calculated separately for each standard?
Yeah, so Trullion does GAAP and IFRS reporting. So it's a great question. It's fully compliant in both standards. And, obviously, as we talked about earlier, when you get into modifications, things very common but very specific, like CPI, there's going to be some differences between IFRS and GAAP. So Trullion is fully compliant there. The nice thing is you can dual report as well, right? So if something happens, or again, you go into a transaction with a public company, you can have the retroactive data to be able to show an IFRS disclosure or journal entry report in parallel with your GAAP financials too.
Okay, great. And just to reiterate, if you send questions through the Q&A, either Alex will answer them if they're sort of specific, or we will get to them live. And if we don't get to, we'll answer afterwards. So with that, let's go to another polling question, if you don't mind, Claudia, please. Okay, this one says, which topic needs the most attention at your company or firm? ASC 606 revenue recognition, ASC 842 leases, ESG reporting, IPO readiness, audit preparation, or something else entirely? And while we're waiting for that, let's talk about maybe another standard that we're seeing a lot more focus on. Cheryl, if you don't mind, would you talk a little bit about software capitalization? Mark mentioned it a bit earlier, but we are certainly seeing a lot more projects come through with requests for those types of projects, and auditors asking for it as well.
Yeah, I mean, certainly it's similar. I feel like I'm harping on process here a little bit, but you know, it's kind of the same thing, like really understanding what costs you have that could be capitalized. You know, certainly we saw a lot of excitement when companies were implementing software for either ASC 606 or 842, maybe getting some synergies and being able to capitalize some of those implementation costs under that guidance. But again, it's kind of a data analysis project as well, you know, pulling what type of costs do you have? How are you going to bucketize them? How can you get some efficiencies through a software tool or other areas like that? So I think it's kind of the same process and understanding what you have, and again, starting early, right, to try to really get on that.
Yeah, and similarly, of course, as you're capitalizing stuff, you can get higher EBITDA, which translates into higher valuations and multiples. So looks like our polling is back. 606 revenue recognition. Looks like people are getting that handled. Leases, still a big deal as we anticipated. ESG, we are seeing a lot more focus on that, and we'll touch on that in a minute. A bit of IPO readiness, since as we pointed out earlier, you can't just get ready to go in a couple of months. It takes probably, you know, around 6 months or more to do a successful IPO. Audit preparation, 'tis the season, and some other stuff as well. So thank you all for answering that. I think we're getting close to the end of our polling questions. We still have one to go in case you missed one of those. Let's talk a little bit about revenue recognition and why that's still important. There were still a few people that mentioned that. Mark, why do you see RevRec still being important to companies?
Well, as we were talking earlier, even though the standard's been out there and it's been effective for some time, there are still several companies that are just now in the process of adopting. And the reason it's important is because 606 RevRec is very comprehensive. It's the most comprehensive standard that the FASB has issued. It's very widespread. It replaces all of the previous existing gaps as far as revenue recognition. And it can take some time to work through the process to understand the contracts and make sure that you understand what the accounting implications are. There's some technical aspects of it that can create challenges. And there's, I guess, broader aspects beyond just revenue recognition. Specifically, 606 also it's actually 340, but there's some cost implications as well. So often companies are not necessarily thinking beyond just revenue because it is revenue recognition, but there are incremental acquisition costs that, if they're required to be capitalized, and there are some reasons why they may not, but then they would need to be put up on the balance sheet. So going back and trying to determine, you know, what that would look like at previous years can be very time consuming. You can be searching for data and trying to get, you know, to the right answers so that you can create an opening balance sheet. And touching back to the revenue though, it is comprehensive, and it also can very fundamentally change the way a company's P&L looks. So I have a real world example right now working with a client where in the past they would recognize, say, 1 year revenue or whatever they had billed or invoiced. And this particular business now is suddenly going to end up having to recognize multiple years up front. So their revenue goes literally in a given period from what it was to 2 or 3 times, whatever it may be. So it can fundamentally change things. Related to RevRec, I'd say it's important once you have your day one, once you get there, it's also very important to make sure that you have a process in place to identify new contracts, make sure the accounting is involved, not after the fact, but when new contracts are being entered into, and that you have a process in place for ensuring that you understand what the implications are and are accounting for the contracts properly.
Yeah, it's funny, when we did some initial 606 implementations, the controllers often didn't have a great understanding of how companies were really going to market. And so there was a large implementation, training, and education process that had to go on so that they could identify new strategies, new products and such. And I don't think that's changed that much. That part is ongoing with companies being innovative, and new things coming up. Isaac, what have you seen? I mean, Mark mentioned data, and he mentioned difficulties in harnessing it. That's sort of a specialty for Trullion. What are you seeing, and how can Trullion help with revenue recognition?
Yeah, definitely. Well, first of all, you don't want any surprises in revenue in 606, right? And so that's, if you look at the public markets and, VMware and UiPath, if you really look at what's happening, we're still learning what type of input 606 has on a business. From a software perspective, one example would be, how you treat bundles, right? In the old world, it might have been more simplified. Now things need to be a little bit more unbundled and at an elemental level, which has an impact on how you recognize components of revenue and also things like, standalone selling price. So the more, I would say, elemental you could get that data, the better you can record 606. So within Trullion, we support this level of revenue recognition. In addition, we provide these things like the AI contract analysis, which in larger contracts is a big part of the revenue recognition process. So bottom line, it's still going on. And in some cases, it wasn't necessarily done, whether it's fully or correctly the first time. So there's some surprises coming up as people go to report.
Yeah, it's interesting. It didn't seem like there were really great revenue recognition end-to-end tools on the market when it came out. So it seemed like companies were mostly implementing, either using Excel, which now they're coming back and trying to implement something that's a bit more efficient in the spirit of our efficiency webcast. For things like gathering information and data on standalone selling price or others. So it's interesting to see the continued evolution even for public companies there.
Yeah, and just to add to that, it's interesting because 605 to 606 and then 840 to 842 were really big transitions. So as a software company, if you were a lease solution 20 years ago under 840, that's a lot different than being a solution under 842. And if you're a revenue solution under 605, that's a much bigger transition. And so in that case, I think the companies were right to stay on Excel and wait for the market to mature a little bit. And that's where we had an advantage, is because we came post adoption of these new standards and were able to build and architect these solutions at the level where there's not these kind of like funny workarounds that you have to do with these standards.
Yeah, sometimes being the first adopter is not the right way to go in these technology solutions. Much as I know, given that I still have an iPhone 8, so I'm with you on that.
I'm 3 Androids behind.
Okay, let's do our final polling question and then just talk a little bit about ESG, and we'll be close to time and can handle any final questions. Okay, this one is, what are you planning in the next 6 to 12 months? Select all that apply. Lease accounting adoption, M&A acquisition, IPO SPAC merger, other exit, technology implementation, or no plans for the future. While we're doing that, Cheryl, we talked a little bit about ESG, but can you tell us what is ESG and why is it an accounting topic that would even rear its head here?
Yeah, sure. So ESG, environmental, social, and governance is, a lot of investors, companies, suppliers are asking how is a company addressing these issues? So for example, the environmental criteria is how does a company safeguard the environment? What are their corporate policies addressing climate change, for example? Social criteria means how are they managing relationships with employers, their customers, their suppliers, and even in the communities where they operate. And for governance, how is a company dealing with their leadership, executive pay, audits, internal controls, shareholder rights? So accounting topic, definitely these are disclosures. They're going to be required by the SEC for public companies, certainly. But private companies, again, investors, customers, suppliers are asking. This is a hot topic in our world today. People want to know and want to invest and buy in companies that are paying attention to these issues in the world. And so that matters, right? If you're underlying, I have a client whose underlying customer very much cares about these issues. They are not a public company, but they are addressing it in their private company, on their website, you know, in their communication with customers, because they know their consumers, you know, that's important to them, and they want to drive that traffic and revenue build. So just because it's an SEC compliance requirement, we're seeing other pressures for companies wanting to comply early, regardless of, you know, the SEC rules.
Yeah, there's a lot of talk about it being good for companies if you have that long-term view. And this is a bit of insight into how companies are focusing on long-term goals as opposed to potentially short-term. Isaac, do you see anything in relation to the companies that you talk to and how they're starting to utilize software to track and report on ESG metrics?
Interesting question. It's still very, very early. So I would say there's not really a mature market around ESG software. There are definitely governance softwares that are working in ESG, whether they come from internal audit or SOX compliant automation. And I think it's actually parallel to the standards themselves, right? There's still a lot of questions, you know, whether it's from CFOs or shareholders as to how do we define ESG and what is the level of implementation we want to do at this point. So I think that it's the same principle in a lot of other markets where software is going to be really, really good in centralizing a lot of the data to make sure you're compliant. The unique thing that Trullion would provide, our company like Trullion, is the fact that we both do unstructured data, so things like documents and agreements, and the structured data, so standard databases. And in ESG, there's going to be a lot of interpretation around unstructured data. But again, Shauna, as it comes to software, still very nascent and early days for ESG.
Yep. And time will tell. It seems like our European and foreign counterparts may be a little bit ahead of us on some of these issues, but certainly seeing some activity at the SEC and even in the private equity-backed specific funds, et cetera. So great. We've got the polling results up here. Not surprisingly, lease accounting adoption. Still some M&A activity happening as we thought, potentially IPO or SPAC mergers, other exits, and of course, technology implementation, whether that's lease accounting software. We're seeing a lot of upgrades from say QuickBooks to NetSuite or other ERP type systems. And some people are going to have a lot of time on their hands. None of these things planned above. So just working on growing their business. So awesome. Well, with that, I think that's all the planned discussion we had. Alex, is there anything else in the chat, in the Q&A that hasn't been answered yet? Okay, great. Well, first I'd like to thank all of our panelists for your contributions today. I think that was a great discussion. I hope it was able to provide our participants with some useful information on how to get some efficiencies in adopting these standards. And certainly want to thank all of you joining the webcast today. If you have any follow-up questions, please feel free to email or call any one of us. We'd be happy to discuss whatever your specific issues are. So thanks and enjoy your day.
Thanks, everyone. Good to see you. Bye, guys.
Thank you, guys. Bye-bye.